Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Let's talk stock market strategies. Particularly today, we focus on the problem with this sell in May and go away investment strategy. Let's take a look. There are a lot of weird stock market indicators that pundits try to use to explain what you should be doing in the stock market at any given time. There seems to be many ideas that people will suggest to determine your investing strategy, including the January effect, the presidential cycle, which team wins the Super Bowl, I'm not kidding, and how well stocks will fare. Based on this month, you may have encountered the sell in May and go away philosophy. While it may sound kitschy and, maybe even superstitious, does this theory actually have any legs? Let's take a look. So what exactly is the sell in May and go away strategy? The basic theory behind sell in May and go away is that the stock market has had a nice run up and during the fall and winter months, which is November through April. As spring and summer approaches, the theory suggests we will begin to see somewhat of a decline during the spring and summer months. If you abide by this, you would sell your stocks in late April or even early May, hopefully realizing nice gains. Then you could sit on the cash until the fall, where you would buy back into the stock market. Sounds simple enough, huh? If you think this idea is brand new, cutting edge, it's actually been around for decades and studied by numerous stock market theorists, which is going to help us out today. Some theorists actually support the validity of the sell in May and go away theory, while others say it's pure hogwash. I like that word. That said, it might be a tempting concept to get behind, either because traders may not be as active during the summer months, or perhaps some just simply think that it's a possible opportunity to time the market. So here's the problem with sell in May and go away. When so many other investors are doing the same thing with their stock investments, it's hard for any one individual investor to see much of an impact. Any quantifiable benefit you possibly would have realized is diluted. Beyond that, the other major problem with this theory is that it doesn't account for your unique investing and financial situation. Listening to others who may not know your specific situation and basing your investment decisions off of them isn't the best way to grow your investments. Following sage advice is one thing, but following pundits without fully researching or talking to others about it is a trading mistake. While it may be beneficial to sell out of some of your stocks, you can only know that after analyzing your holdings in light of your investment needs and goals. Sell in May and go away, historical returns. Let's dive in. Okay. So LPL Financial measured the S&P 500 index May through October returns during the decade of the 2010s and found an average of a positive 3.8% return each year with no significant declines. The S&P 500 was also up 10.5% from May to October 2021, though it was down 5.3% during the same period in 2022. So who are you investing for anyway? At the end of the day, it all comes down to deciding on your investing strategy and sticking with it. Some people might look at the long-term fundamentals of a company to invest in. Others may prefer investing in index funds and forgetting about the money due to a long-term investment horizon. Those are some of the basics, but the point is to have a plan to guide your decision-making. That helps you plan for your retirement and create a portfolio that can get you there. If you have long-term investing on the horizon, you don't need to worry about whether it's time to get out of the market. Instead, just ignore the experts on CNBC and stick to your plan. That means if you put new money into the market every month or quarter, then just keep doing it. If you rebalance every quarter or semi-annually, then keep doing that, unless your underlying goals change. So is there a benefit of not following the masses? If you have read The College Investor for long, you'll know that we love Warren Buffett and have him listed as one of the best investors of all time. Buffett doesn't let what others say affect his decisions on investing and says his philosophy is just to hold stocks forever. While that's not the only investing strategy, It's one that has obviously worked for Buffett over his long career. Whatever your investing strategy is, stick with it and don't follow what everyone else is doing. The bottom line, if you take a long-term approach to investing in the stock market, you probably won't want to sell in May or any other time just because it happens to be part of a catchy rhyme. And that rhyme too. You may experience potential downturns, but you'll also take advantage of potential gains if the market goes up during the summer months. Over time, the long-term returns of the stock market are hard to beat, and timing the market is not something that many people can do on a reliable basis.